Rob's Child, nothing I say is any kind of investment advice. Welcome back to the series where we go over every chapter of Benjamin Graham's The Intelligent Investor Revised Edition from the early 70s. Today's episode will be on Chapter 2, The Investor and Inflation. This topic is especially relevant to today when inflation has been considered to be sticky in June of 2024. So we will go through the main points of this chapter, see what we can get out of it for talking about markets today, review the chapter, discuss some things, and I might be able to give some insights how it compares to his, biblical tome, The Security Analysis, the second edition, 1940. So here we begin. Chapter 2, The Investor and Inflation. First point in the intro of the chapter, he mentions inflation being a problem in 1971 and 72. I believe it was starting in 1965. We'll get into that more later in the chapter. He makes an interesting point about, I think it was a charitable institution was advised to be 100% in stocks, which, you don't typically want an organization, an institution to have too much risk, but being advised 100% stocks, that tells you something about the times that they were in. And he notes, previously trusts it was the law actually that they were only allowed to have capital sitting in high grade bonds because, stocks are not 100% safe. Notably, in the link in the description has a version of the book with another commentary that does mention that how, he makes a comment here that he's not too worried about inflation because he believes federal policy would be more effective moving forward, but this is incorrect. If you know about history, the beginning of the 1970s was really the beginning of the worst inflation the United States had ever seen. Most people today attribute that to the demographics, the baby boom. There were so many people trying. The economy was expanding so fast that that was really what was driving inflation. Just ultra high demand. Just demand, more demand, more demand, more demand of goods and services. Then he discusses how he casts doubt basically on stocks always being the best thing to invest in. I have a triple star. I put stars next to points that I think are especially important. The more stars, the more important I think it is. This one has 3 stars here. There's a quote I wanted to read. There is no close time connection between inflationary or deflationary conditions and the movement of common stock earnings and prices. The reason why I wanted to highlight this was simply because a lot of people say how stocks are a better inflation hedge than a lot of other things. And he says that there's, while he admits at the end of the chapter that basically is sort of true, it's important to recognize that there's no close time connection between these conditions. And so if inflation is going crazy, the main point is that it doesn't necessarily mean that earnings are going to be growing at an equal pace as inflation. And in fact, a lot of the times it's the opposite. So then we discuss an example, 1966 to 1970, the cost of living went up by 22%, and while stock earnings and prices actually dropped during that 4-year period. And so if you were trying to protect yourself from inflation by buying stocks, you would have not been doing so well, obviously. And so he states there are many more examples throughout history that you can find that are like this, where the cost of living is going up and up, and stock earnings and prices are actually going down at the same time. Moving on, we have a quote here: no general tendency for earnings to advance with wholesale prices or the cost of living. Actually, this rate has fallen rather markedly in the past 20 years in spite of the inflation of the period. So if you can't get earnings growth from inflation, well then where do earnings growth come from? And this is a 5-star comment that I wanted to highlight here. He basically says that earnings growth comes from growth of invested capital coming from reinvested profits, not from inflation. And he goes on and on reiterating and exemplifying this point. And he has an example of additional debt adding to earnings, but not proportionally. In other words, companies doubling their debt, but not doubling their earnings, getting a lower proportion of advance of earnings. To explain a little bit deeper this little quote here, growth of invested capital coming from reinvested profits, I believe this means basically a company, when a company earns money, it doesn't all go directly to the shareholders, to their pockets. It doesn't come out as a dividend. Usually it's a percentage of earnings. You can actually find that information pretty easily on most stocks these days. But the idea is that the earnings that they retain help them grow the company. So they open another store. They, expand the business so that they can then earn more money. And, that makes sense. So the next point we actually mentioned utilities. Sorry about spelling errors. You're going to find them here. It's because its notepad doesn't correct them. Utilities, supposed to say utilities, might be a good for inflation. He says, in this time anyway, by law, they were entitled to charge rates sufficient for adequate return. So I find that to be very interesting. I'd be curious to see how much that holds true still to today. Next notable point, he notes that it took 25 years for General Electric and the Dow to recover from the Depression. And so, if you're using stocks to seek safety, it's not always going to give you safety. And this whole chapter ends up doing nothing very much more than reiterating the previous conclusion that a good portfolio should never be less than 25% stocks, 75% bonds, and it should never be more than 75% stocks and 25% bonds. And this takes into account the idea that you can have depressions, you can have runaway inflation, you can have all sorts of crazy things going on. But at the end of the day, it sounds like he goes back to that basic rule. But to go on, I have a 2-star point here, and I quote, this is a long quote here, I'm just going to read it through. I hope there's no copyright violation here. I don't think there is. I doubt that I'll have any problems with this, but we'll see. If the investor concentrates his portfolio on common stocks, he is very likely to be led astray either by exhilarating advances or by distressing declines. This is particularly true if his reasoning is geared closely to the expectations of further inflation. So do not depend on your stocks to advance just because there's inflation. And so many people today in 2024, where the S&P 500 is pretty darn expensive, PE ratios are high, people are doing this exact thing today. I'll note many target date funds, there are target date funds that go as much as 90% stocks or maybe even 100% stocks at this point, if you have enough of a time. Because the idea is, if the time is long enough, you're 100% guaranteed to have no problem, in that time period. And I'm not sure what Graham would say that about that today. Looking at the time horizon, this is more geared towards the fact that most people, the purpose of this book is to get people to invest themselves, right? To be active investors. And part of the problem with being an active investor is the psychology of seeing things not play out the way you want them to, especially, with stocks. And so, this takes into consideration more shorter time frames, I think, generally speaking. Then, and when I say shorter time frames, I'm talking like 4 to 10 years. If your time horizon for your investments is like 20, 30 years, I think he would think a little differently. Well, we'll have to see if he gets into that at all in the book. Graham does have a way of answering my questions after they come up in my head. He did that a lot when I was reading through security analysis. But to finish the quote, if another bull market comes along, he will take the big rise not as danger signal of an inevitable fall, not as a chance to cash out on his handsome profits, but rather as a vindication of the inflation hypothesis and as a reason to keep on buying common stocks no matter how high the market level nor how low the dividend return. That way lies sorrow. So the point being here is be aware when stocks are overvalued. Period. He would look at stocks today, and like I'm saying, I think he would be 75% bonds and 25% stocks right now. If you look at the yields of bonds right now, the 30-year bond is something like 4.5%, something like that. The Fed funds rate is target is 525 to 550, all while the PE ratio of the S&P 500 is close to 30. It's above 25 still, I think, and the math doesn't really work out. So that's why I think that. Moving on, the subtitle, we have a section on the alternates to stocks for inflation. So if you can't use stocks for inflation, what do? He says, okay, well, what about gold? He says, okay, sure, but no income. He mentions, I believe, a period where it really would not have been to your advantage to use gold as an inflation hedge. And same with collectibles like watches or anything that seems to that might increase in value. And he says for the readers, the swimming is not safe and easy there. So he's saying, yeah, you can do it, but it's not safe and it's not easy. If it was easy, everyone would do it, obviously. So what about real estate? Well, he says, no, not really. Real estate, I don't know. Oh, yeah, he states that real estate can go up and down pretty dramatically in time. You don't really know what's going to happen and when it's going to happen. So the conclusion of this chapter ends up being that that it is axiomatic, the ultimate truth that the conservative investor should minimize risk, and that there is no certainty that stocks will protect you against inflation, but it has more protection than bonds. So, this is the other thing about today that makes me think, well, maybe you wouldn't be 75% bonds, 25% stocks, considering that we are currently experiencing higher than normal, higher than expected, higher than desired inflation levels. The Fed target being 2% right now in 2024, supposedly. Some people think that that's just a lie, but we won't get into that too much. So maybe he would be 50-50. I kind of doubt it, mostly because of the current PE ratios versus the yields on Treasury securities. But anyway, then we have the last part of the chapter I wanted to do. He quotes his own 1965 edition, stating that even when stocks are expensive, and this is a quote, the defensive investor cannot afford to be without an appreciable portion of common stocks in his portfolio, even if we regard them as the lesser of two evils, the greater being the risk in an all bond holding. So there you go. If your main concern is inflation, it's the better of two evils. Even though stocks may not even do well, it's better than having all bonds. So, again, I feel like he'd be inclined to today, although he lived through the 70s. I don't know, or I think he died in the 70s. I don't know if he lived through the 70s and was alive today. The question is, the essential question is, what would he think today after living through the 70s, and thinking, portfolio allocation? Would he be 75% bonds because the yields are so high and the valuation of stocks seems to be so high? Or would he be 50-50? Or would he be really concerned about inflation continuing higher and therefore have a higher allocation to stocks, like 75% stocks, 25% bonds? I'm not sure. I think so far he's kind of leaving it to the reader to try to figure out what they think, what they feel about what's going to be happening moving forward. And that's all for this chapter 2 of The Intelligent Investor by Benjamin Graham, early 70s edition, the revised edition. Hope you enjoyed. Thank you for watching, and see you next time. Rob's Child.